Hey, how are you today? You know that markets move in a disciplined and structured way because millions of people who are trading it have structural minds. But how we can use it to improve our results? With a very powerful concept named order flow, and we use structures and break-off structures to identify the current order flow of the markets. We have three kinds of break-off structures, so watch the video until the end so you learn the kinds of break-off structure. Mehran's here, your trading companion, and in the fourth episode of our free Smart Money Concepts course, we are going to learn break-off structure, concept of order flow, and break-off structure types, which keeps us on the right side of the market. The lack of knowledge about order flow is the main technical reason that destroy traders, because they know a lot of setups, entry patterns, and etc., but they don't use them in the correct direction and in the right context. So with the help of order flow, we can identify the current direction of the market with high accuracy and then try to catch trades in that direction with a good entry setup. But how to identify order flow, right? With a structure and break-off structure. We talked about a structure in the last video in free Smart Money Concepts course, and now we want to use it to identify our order flow. Let's talk about this concept on charts. We talked about the concept of market structure in the last video, and now we are going to see that on the Bitcoin daily chart. So what is the market structure and why is that so important? The market structure is the last obvious swing high or the swing low that is broken right now. I mean, we have the last swing low and the last swing high from here to here, and now we can see that the market broke its low. So the market structure is broken to the downside, and we try to catch selling trades. For example, in this area we have an order block here, it got liquidated. We can find shifts in the lower time frame. I talked about shifts a lot in this channel, so you can find that in the channel. And after the shift happens, you can enter selling trades. We don't look for buying trades after a break-off structure to the downside. First, let's see its schematic, and then let's talk why a break-off structure shows that the composite men or the people who have the knowledge and the money can't let the market go above the protected high or low that we are going to talk about in this video. So how to identify our structure and how it gets broken. We should first identify our primary structure, that is going to be from here to here. The last obvious low and obvious high is our primary structure. Then we wait until the high or the low gets broken. For example, the market comes down and it breaks the low. Now we have our protected high here, so it is our protected structural point, and it should get protected. Why? Because the composite men, the market makers, the people who have a lot of knowledge and money are going to risk their money in the leg down. They are who are selling these markets or buying these markets in an up move. So they are selling the markets. The least thing that they are going to do is that when the market is starting to come up, they stop buying the market. They have a lot of sell orders in the impulsive move. If you are a bank trader, if you are a market maker, do you risk your money in the impulsive moves that are the big moves, or in the correction moves that are the smaller one? Or you are going to risk your money in these moves? So they have been risking their money in this down movement, and now the least thing that they can do for preserving their money is that they don't do anything when the market starts to come up. So first they may add to their selling positions when the market is coming upward, because most of the time the market is going to continue its movement. And the most important thing is that if the market comes higher than this high, they are going to be in negative numbers, and they hate negative numbers. So it's important for the market to keep this high protected. It's why when the market structure, for example, we have our primary structure from this low to this high, and if the market breaks its high, most of the time the market will just retrace a little bit and continue its movement to the upward, because these men who are creating these impulsive moves are the main traders, the bigger ones, and the people who are making these moves are them covering their profits and closing in profits, or are the retail traders who think that the market is going to go downward and just no reversal patterns. So when we have a protected structure like this one, what is a protected structure? The structural pivot or point that breaks another structural pivot. You can see that we have our structural pivot here. It comes up, it breaks this structural point, so it is a protected one. It comes up, it creates another low, it breaks this structural point, so it is a protected one. So the break of structures shows us the way that we should try to enter the market and the direction that we should choose to find our trading setups. So if the market is breaking higher structural points, we are trying to look for higher lows, for example here, because it broke this high. And if the market is breaking lower structural points, for example here, we try to catch lower highs. It's more probable and it's reasonable. Now let's talk about break of structure. First we identify our last swing high and swing low, as I said. Then we should wait for the structure to break the high or the low. We can see that the high broke, and that will show us the order flow or direction of the current movement of the market. So we try to catch higher low, for example, in these conditions. Now we are going to talk about types of break of structure. First of all, you should choose your break of structure type wisely based on your character, and you should continue using it repeatedly. You can just use some kind, for example today, and another kind next day. You should choose one method and stick to it for your trading journey. For the first kind of break of structure, we first identify the highest and lowest shadow of our primary structural points. For example here, this high broke this low, and this low and this high are our structural points. So we first identify the highest point of this shadow and the lowest point of this candlestick, and we wait until the structure breaks with the shadow of one candlestick. So when the structure breaks with this shadow, we have our break of structure. We identify our protected leg, that is from here to here, and we use our tools to find where is going to be the most probability higher low that can be under these points of liquidity in this imbalance. So we identify our first primary structure, we identify the lowest point of its shadows. Then we wait until one of these points, for example the high, gets broken with a candlestick's shadow. When it happens, we have our break-off structure and we can try to find buying setups in good POIs. In the next type of break-off structure, we first identify the highest and the lowest open and close of our primary structure candle. I mean, here is our highest point of our primary structure and here is the lowest part of our primary structure. But for this one, we identify the open and close of this candle, that is going to be here, I mean the body of the candle, or here, that is the body of candle as well. So when a candlestick break those structure with its body, for example here, so in this kind of structural break, we should wait until the candle finish its formation. When it breaks the primary structure with its body, we are going to have a break-off structure. It is our protected leg, so we can use Fibonacci tools, liquidity points, POIs, support and resistances, any kind of method you are using for finding your POIs, we can use them to find our higher low somewhere between this point and this new high. Let's talk about the last kind of break-off structure, and for that we identify the highest and lowest shadow of the structure. Then a candle should break this highest point or this lowest point with its body. For example, here we have our highest point, here we have our lowest point, and when a candlestick breaks it with its body, for example here we have our break-off structure. So it is a little bit different from shadow to shadow. It is shadow to body. So this shadow should be taken out with this candle's body, or if this candle has its body here. Then we try to ride the trend in this leg from this point to this point, and we try to catch the higher lows. So you should pay attention to these kinds of break-off structure, but you should choose one kind of break-off structure wisely and use that as your methodology, and you can't change that. You should use that repeatedly every day. But what is the difference? For example, when we have shadow to shadow break-off structure, you can see that sometimes the market comes up, shadow our structural points, and doesn't close that with a body, and we have only a shadow. And for myself, for example, I use body to body break-off structure. I can't find this trade because it is not on my trading plan. I use break-off structure with the body, but for entering a trade I use shadow to shadow. Anyway, but for a structural view I don't get this trade because it broke this high with a shadow. But sometimes it just comes up, shadow the structure, and it breaks down. So with a shadow break-off structure, you may have, I mean type 1, you may have more opportunities to enter the trades, but the probability is going to be lower. But with a body break-off structure, for example, we have here, you may miss some trades. A body that breaks the shadow, you may miss some trades, but it's higher in probability. Some people use body to body, and that's okay too. For example, if you use a line chart or other kinds of the chart, the body to body is the thing that you are seeing on your chart, and that is going to be okay. But for myself, I use a shadow and wait until it gets broken with the body of a candlestick. So let's close this concept with some examples on Bitcoin. Here we can see that the market is going up. Our primary structure is from this shadow to this high, and you can see that the high has been broken. So our primary structure is from this low or this low to the high that starts the pullback, and then it comes down and breaks this structure. Now what we have our major leg from this point to this point, so we can enter trades and find our lower high that we are going to cover in the channel in this area and sell the Bitcoin. Then our primary structure is going to be from that high to this low, and you can see that it comes down, breaks the structure. Why I did change it from this point to this point? Because it's just a shadow. So when the low breaks with a body like this, we have our break of structure. So it is here, and it is going to be this low. Another thing that I'm going to mention is that if a person wants to use shadows to find break of structure, that is okay. You can see that here it is a shadow and it worked out because it made a lower high. Again, it came down, it broke this low with a shadow, and this larger movement worked out well, and it provided us with a lower high again. Now the low is broken, and we try to get selling trades from this leg or this leg. Both of those legs are good points. You can see that it pullbacks, it breaks the low again. So we have our primary structure, I think somewhere around here to here, and we try to catch lower highs. You can see that it worked out. It is enough for a wonderful trade, and now we should wait until this high gets broken, or this low gets broken, or this high gets broken, because they are our protected structure. This high is our protected structures, these two highs. This high is not protected, it's an internal structure, but it is an important one. Let's see what happens. We wait until the low or the high gets broken. We have our low getting broken, but that's insignificant. Let me pause this. Our low got broken with a body, so we have our primary leg and our major leg, our important leg from here to here, so we can try to catch this lower high, and it worked out very well because it is going to be a wonderful trade. And now we can wait until this high or this high or this low gets broken. Let's see what happens. It broke this high with a shadow, so maybe it will provide us with a higher low for the people who try shadow for the break of structure, but that's very long shadow, so this shadow shows us a very important resistance here. Now the low gets broken and we try to catch lower highs. You can see that some kind of lower high happened here, but we are going to wait until a better lower high. This shadow was our lower high, so now we should wait until the price actually breaks this high or this low. Why? Because we are going to try catching, for example, these kinds of trades, and when it happens, all the orders that is going to be selling orders for this situation, because the low has been broken, are absorbed in this shadow and this movement. So now we just wait until one of important highs or lows like here or like here or like this high gets broken. Let's see what happens. The high gets broken. We can try to catch higher lows, and you can see that it happened here. Again, the high got broken. We can catch higher lows, for instance, and you can see that it works out very fine. And we wait until the low gets broken so we can enter selling trends and selling setups. You can see that it worked out. Again, the low gets broken. We try to catch selling setups, but I think it's a good place to buy again. Why? Because if you pay attention to our scale, this strong movement broke many of the structures. So sometimes you should zoom out, you should change your time frames to see what happens. I just was paying attention to the numbers and I thought that so the Bitcoin declined for 70-80% of its price, so it is going to be a good spot to start buying Bitcoin, for example, because it needs a retracement or a impulsive move to the upside. It's so much deep in discount, and you can see how does it work. Now we have our break of structure from this point and this point, so we can try to catch higher lows. Both of these legs are important, this bigger leg and this one. Why these are important? Because it has its own imbalance and it has its own imbalance, and the imbalances are the liquidity providers for the market. It's like fuel. You can see that it bounced from this imbalance. So it is enough for today. Just pay attention to the concepts, try to learn them and practice them. Yes, I know that it is a very long journey. I'm not like those gurus, those scammers who wants to sell their courses or who wants to just absorb some viewers for their channels so they make money from ads. I'm not like them. You can't survive in a market like Forex or cryptocurrency, which has a large amount of money in it and which has a lot of strong, powerful and knowledgeable market makers who has a lot of money and a lot of stuff and a lot of knowledge, and you can survive in these situations with, for example, a 10-minute strategy that you can find out there on many YouTube channels or other courses that you know what I mean if you are in this industry for a period of time. So I'm not like that. You should learn these concepts step by step. You can see that it's episode 4, and after that you practice them, you get mastered in them, and you mix, for example, a structure with trading setups and Fibonacci's and order blocks and liquidity points and all the concepts that I'm going to provide you with, and you are going to be a non-stress trade. In return, we are in Iran in an internet blackout. We don't have good internet connection, so your support is much appreciated. You can support us with likes, comments, viewing and sharing these concepts that I'm sharing with you for free, and in return you are going to learn a lot of concepts, working practical concepts that you can't find in any other expensive courses. But you should pay attention to playlists, and you should subscribe to the channel because they are in sequences. And for example, we have a playlist named Ultimates, and I'm going to provide you with a complete course in one video. For example, we are going to talk about liquidity in 1 or 2 videos on that playlist, and a playlist is named SMC course for free, and you can see those videos in sequence so you don't miss a concept that is going to be important for you as a trader. Anyway, thank you for your watching. Have a good day and goodbye.